wonderful women. And he is the Executive Director Emeritus of Humboldt Area Foundation, the community foundation serving Humboldt, Del Norte, and Trinity Counties in Northwest California. During his leadership, the foundation grew from 78 million in assets in 2012 to 179 billion in 2021. And of course, any of you are welcome to continue contributing and set up new programs there. They've made a huge difference in helping various programs and people's desires to contribute to the community. He has served as president of Lost Coast Communications, Inc., a radio and online news media company serving the North Coast since 2003. Prior to moving to Humboldt County in 1997, he was a managing director of Chase Manhattan Bank and a partner in TCW Capital, a private equity firm. He is a chartered financial analyst, an avid amateur musician, and serves on the board of Life Plan Humboldt. And he's joined today by three well-known what I call medical entrepreneurs as panelists. That is Rose Gale-Zoellick, Executive Director of the Breast and GYN Health Project. Mary Keehn, founder of Cypress Grove and board president of We Are Up. And Ann Lindsay, local physician and board president of Life Plan Humboldt. It's all yours. And if you have questions, please feel free to put them in the chat. But after Pat discusses, he'll do the introduction. He'll leave it opening for questions. Okay, go for it. Thank you.
Okay. Good afternoon, and I'm really heartened to have 28 people on a call to talk about tax strategies. I mean, that was not, I didn't anticipate that big a crowd. What I'm going to do here, I do have a brief outline that we will be using here. Yeah, if you want to put questions in the chat, or we'll have some time after this. This is not the most scintillating presentation I've ever given, but hopefully it'll be interesting to you. And what we're talking about is tax savings and charitable giving. And I want to just, first of all, thank everybody who helped put this together. The OLLI people, the Life Plan Humboldt, We Are Up, Humboldt Breast and GYN Health Project, Humboldt Area Foundation, and also Sarah Newblin from Edward Jones provided me with some useful information. So my wife is a retired attorney, so I have to give you my disclaimer here. We're going to talk about giving. And we're going to talk about how we use the tax code to maximize giving. It's based on my experience and my own research. I'm not a lawyer, and I'm not a CPA. So this is not tax advice. This is to suggest some added ideas and strategies for you to pursue charitable giving, but you really need to consult either your tax preparer or your attorney before doing any of these, because your situation will be different. This is based on averages and the average person. And it's really important that you get the good advice. So, okay, having done that. The reason we're doing this is that the IRS does have some provisions that can result in tax savings for charitable contributions when done correctly. And we're going to just look at some high-level discussions of how that can work. And how increase the impact of your giving. One thing I found with people a lot of times, that they think the tax strategies are going to pay for all the giving, and that is not going to be the case. The tax strategies will help decrease the cost of giving, but at the end of the day, you will still be giving something to a nonprofit organization. So, that's important to kind of just keep in mind that this is all based around a charitable intent, that you want to support an organization you care about. How do we do that in a way that perhaps the IRS can help you with to maximize? Briefly, we're going to talk about 5 broad areas of charitable giving and how they can work. And I'm sorry, my figures, once I started talking, my throat would. Okay. Get clogged a little bit there. So we're going to look at IRA distributions. We're going to look at gifts of stock and other appreciated assets. There's a whole range of planned giving vehicles, such as charitable remainder trusts, that we will briefly go over. If I were a tax attorney, I could talk about that for a couple of hours, but we'll just kind of give you a brief overview of that. We'll talk about donor advised funds and just some other planned giving options. So that's basically our outline. So the first thing I wanted to talk about is IRA distributions. And one of the things that the tax code has made available now is that you can take a qualified charitable distribution from your IRA and send it directly to a charitable organization once you reach the age of 70 and a half. I don't know why 70 and a half. There's no logical reason for that number, but that is what the law is. And you can give up to $105,000 annually from your IRA if you qualify. And one of the things I wanted to talk about is, why would you do that as opposed to taking the distribution and then turning around and writing a check? And the reason is that taking the distribution can put you in a higher tax bracket. It will increase your adjusted gross income, which could limit your ability to take charitable deductions. And so, probably the most famous example was, there was for those of you who are old enough, there was a boxer, Joe Louis, who got paid $500,000, and he gave the $500,000 to charity, and the IRS came in and said, no, you can't deduct that full $500,000. So you still owe us money for the income. So by doing an IRA distribution, you never receive the income. It never shows up in your tax return. It goes directly to the charity. And that is a strategy that pretty much all the IRA administrators at this point have forms online that you can fill out to do this. And then if you're of the age of 73 or higher, you have to take a distribution from your IRA. You can't postpone it any further, but you can use a qualified charitable distribution to satisfy that required minimum distribution. So this is a very effective strategy for giving sort of painlessly, to some degree, to a charitable organization. Then I want to talk about gifts of stock or appreciated assets, and we're going to talk about a gift of stock in this case. If you have an asset, let's just say you bought Apple computers 30 years ago, You don't have much of a tax basis in that. If you were to sell that, it would trigger a huge capital gain liability for you. However, if you were to contribute that stock directly to a nonprofit, you will not recognize the gain or loss. I'm going to go back for a second, just to answer Ken's question. Yes, Roth IRAs, this applies to Roth IRAs as well. Sorry, I just seeing the chat's a little behind time. So back to the gift of stock here, I just threw an example. Say you wanted to give somebody $10,000 and you had a choice of giving cash or contributing appreciated stock. You can see here that you would avoid $1,200 worth of capital gains tax, and lower basically the after-tax cost of your stock. This can apply to other assets too, including real estate. When we were at Humboldt Area Foundation, we had somebody contribute an office building to us. Now, obviously, you want to be careful about what sort of assets, if you're a nonprofit, you want to be careful about what you accept, because somebody could be giving you something that's got underground storage tanks or has some liability to it. So you need to be careful on it. But it's a very effective tax strategy to avoid realizing the gain or loss. Let's see, there we go. Another thing that is a very effective tax strategy are what they call charitable remainder trusts. And again, this applies really well with assets that are very highly appreciated. Again, stock that you've owned for a long time, or perhaps a rental property that you've owned, that the sale of which would contribute a lot of taxes. And I think that the thing that we want to look at here is, let's say you had a rental property that's generating income for you at the current time. With a charitable remainder trust, you can contribute the asset to the trust. It is tax-free to the contribution, and then it can generate income either for a period of time, including the rest of your life. And that income can be either a fixed dollar amount per year or a percentage of the value of that account. And what would happen, let's say you were to contribute an office building or a rental property, the trustee would then sell that and invest that money. And they would be responsible for contributing money over time to you, and then at the end of it, the money goes to a charity. So this is probably a simple way to say it. So yeah, as I said, the asset gets contributed, the payout's determined. You'll get a tax deduction for this, dependent, and the computation of charitable remainder trust involves actuary tables and accountants and lawyers and things like that, but it's going to be based on kind of the present value of the income stream that will be there. And then at the end of it, at the death of the last beneficiary, the remainder of this will flow to a charity. So let's see if we can do an example here. And I apologize for the small print. This is an old, oh, there it is, old example, but the idea is that somebody contributes a rental property that's worth $500,000. They bought it years ago. They have a $100,000 basis, and they would be paying tax if they were to sell that asset and reinvest it. Instead, you invested, that money is contributed to the trust. The trustee then sells the property. It is then invested. The person who contributes to the trust continues to receive an income stream. And at this point, you'll see that the amount of money that would be left over at the end of this is higher doing a charitable remainder trust than it is if you simply sold the asset and paid the taxes up front. In addition, the lifetime income would be higher because, again, you have more money to invest because you're not paying taxes on. So, so charitable remainder trusts are, they're complicated and they're going to cost a little bit of money to get an attorney to do this, but it can be a very worthwhile thing to do and benefit a charity at the end of the process. The next thing I wanted to just chat about is using a donor advised fund, and donor advised funds can be set up at Humboldt Area Foundation. They can also be set up with a lot of the brokerage firms these days. And a donor advised fund has a number of advantages to it. Again, you can contribute appreciated assets to it and avoid the capital gains tax. You can use cash, securities, real estate. In some cases, you can even contribute a business. There are lots of caveats to that, but that can be done. And the advantage of a donor advised fund is if you have a particularly high level of income one year, and this is kind of how my wife and I use our donor advised fund. If we have a lot of income, we make a large contribution to a donor advised fund, and then we pay out to the charities that we support out of the donor advised fund over the next several years when we're in a situation where we won't be able to deduct our charitable contributions. So you can kind of bunch your charitable giving to hit the threshold, get the tax deduction, and then use that fund to support your giving. You can also give, some donors want to be anonymous, and a donor advised fund will allow you to do that. And then the other thing that people kind of compare donor advised funds to is, well, it's kind of like setting up your own private foundation. But there are some disadvantages to setting up your own private foundation. Private foundations have required minimum distributions of 5% per year. They have taxes on investment income. They require annual tax returns to the IRS. So, donor advised funds are a lot simpler to do. Okay, and then just the last thing to think about in terms of supporting charities is just to think about adding causes that you care about to your estate plan. And I like to tell the story of one donor we had at Humboldt Area Foundation who had 3 children, and he left them each 25% of his estate, and the other 25% went to a charity that he had worked with for quite some time. And it can also help with estate taxes, which are really not much of an issue these days, with $13 million as being the taxable level for an estate. Not very many of us reach that rarefied thing, but it is a way to support your local charities. So, and with that, I'll start taking questions. I'll look at the chat Please explain Sherman's comment. Oh my God, Sherman's the accountant. I'm gonna have to, let me see if I can. Right. Sherman's point is, if you're not able to fully itemize your tax deductions, that's where a qualified charitable distribution from an IRA will take care of that problem. That's why it becomes a much more efficient tax strategy to do it.
Can you explain why? I don't understand why.
Because the IRS will start to eliminate your tax deductions when you reach a certain level of income. You know, and that gets into like alternative minimum taxes and other obscure tax provisions. But somewhere, and I'm not familiar with the levels at this point, but it's not that high. If you're single and you're at 100,000, 150,000 or so, your ability to itemize deductions starts getting limited. And so that's why distributing it directly from the IRA keeps it out of your income. Yeah. And it's, you know, we should have Sherman actually teaching this course because he knows how to do this. But you may still benefit anyway. So there's really very little downside to doing a charitable, a qualified charitable distribution.
Could you go back to
from a
that
tax.
slide so we can look at it again?
Yeah. Yep.
I have a question.
Okay.
There it is.
Okay.
Okay. And then you had the table as to how that worked. So,
No,
okay. So you
that-
contribute $10,000, and how does that relate to your required minimum distribution?
Oh, that
So
was a
is it-
different, I'm sorry, Jane, I moved on to a different bullet point here. So that is an example of a stock gift or a gift of an appreciated asset. So that is a different,
That's a different one. Okay.
that's a different, yeah.
So you have a qualified minimum, you have a minimum distribution of, let's say, $50,000, all of which is taxable at whatever tax rate you're at. Okay. If you distribute, how do you actually distribute it? How does this work?
So you can go to whoever your trustee is of your IRA. Let's say it's Charles Schwab, just for an illustration, and they will have a form online where you can fill it out and say, I would like to do a qualified charitable distribution. Here's the amount I would like to do. And, you know, here's the organization I would like to receive it. And they will process it for you. In some cases, they will send the check directly to the charitable organization. In some cases, they will send it to you and you can present the check to the charity.
So the
But
implications are if I distribute 10,000 out of 50, then I'm only taxable on 40.
That would be correct. Yes, if you took the 40 as a distribution to yourself, you can do a portion of your IRA distribution up to 105,000.
So if I go ahead and take the RMD myself and then do it, I have the tax benefit if have deductions of deducting the 10,000 instead of doing a qualified distribution, right?
Yeah, I mean, the worst case would be that, it would be a wash. I mean, or the best case is it's a wash. But what it will also do is potentially put you in a higher tax bracket because you will be showing higher income. So additional money that you may receive may be taxed at a higher rate.
Okay, I see. Okay, that makes sense then. So if it bumps me from 28 to 22 or whatever, that would
Yeah.
be the benefit of doing a qualified
Yeah.
distribution.
Yeah. This is nice and clean if you just do the qualified charitable contribution. It never shows up on your tax return.
But it does satisfy the RMD.
Yes.
So, okay, so the main benefit is you get to make the contribution without having, if you can't itemize deductions for some reason, you can make the contribution and you reduce your taxable income.
Yeah. And even if you could, these days, the standard deduction is, I think it's 22,000 for married. So it's a high threshold these days. We have a question here from Mr. Kalsa.
Yeah, thank you. So my question is, when I die, I want to leave my my money to a number of different or charitable organizations. So I have that in my trust, but I'm not sure quite how to do that with my IRA. There are probably maybe 20 different organizations that I'm going to divide it. So
You should be able to set that up. I mean, the one caveat is that the large, the large financial organizations will try to put a limit on that, on how many you can leave. And so that's a situation where perhaps you could set up a fund at Humboldt Area Foundation, and have the IRA payable there.
and if it goes to Humboldt and the Humboldt Area Foundation and then other charities, is there taxes taken out of that, or how does that?
No, an IRA that is paid out to a charity has no tax implications.
Okay.
Up to a limit. Or does it?
Not on an IRA. Upon your death, an IRA is outside of your estate. So that's not taxable. I have a question here from Kay Escarga. Can you do out-of-pocket contributions and deduct from? Yes. Well, can you do out-of-pocket donations and deduct that from your income tax in addition to doing a qualified charitable distribution? And the answer is a very definite maybe on that. If you are eligible to deduct, meaning your other, tax situations are, yes, absolutely, you should be able to do that. There's Sherman once again with our standard deduction is 14,000 for single filers, 14,600, 19,200 for joint filers. And a number of details. Again, I'm not giving specific tax advice here, but it could be, so to Kay's point, you have to make sure that your deductions are higher than the standard deduction in order to be able to deduct it. And if you're single, the federal government now has a limit on how much you can deduct on state and local taxes of $10,000. So so it gets hard, especially if you're filing jointly, to hit that threshold for the standard deduction.
So if one wants to consider doing something like this, do you have to go to your tax attorney, or do you come and talk to the Humboldt Area Foundation? How do you carry this out?
I mean, I think it's always good to talk to whoever does your taxes for you. I think that would be my first advice. Humboldt Area Foundation does have a staff that can help you specifically with charitable remainder trust. Also, I'm not up to date, and I don't. I was thinking that Laurel Dahlstead might be on this call, but I don't see her. But Humboldt Area Foundation used to provide a service for nonprofits where you could give the stock to Humboldt Area Foundation, and they would turn around and then give that to, say, Humboldt Breast Project or somebody like that. So they can be very helpful in this as well. But I always have to say that you need to talk to your tax advisor. So with no further questions, I think maybe it'd be a good time to transition to the second part of our program. And I think we drew straws, and Rose from the Humboldt Breast and Health and GYN Health Project was going to talk a little bit about her organization and some of the things that they're doing. And so, Rose, I'm going to turn it over to you.
Oh, thank you, Patrick. So I'm Rose Gale-Zoellick. I'm the Executive Director at the Breast and GYN Health Project. I have been Executive Director for 16 years here, and I was on the Board of Directors for 3 years before that. I'm not, but the organization was around for about 10 years before I started. So we will soon be approaching our 30th anniversary of being a local 100% grassroots organization. And kind of what that means is that all of our, so our budget is only about $500,000 a year. We have 8 employees, not all of them are full-time. And we rely, only 20% of our budget is grants. So we do a lot of fundraising, and many of you who are on this call are donors to the Breast and GYN Health Project. So that's the grassroots involvement on the donation side. And then we have a ton of volunteers who are the heart and soul of the organization, who keep us going. So I think that's why we were invited to be part of this call, was because we are up, and Life Plan Humboldt are also kind of a grassroots, just getting up and running organization. So it's really kind of cool to be on the call with you guys today. I wanted to take just a couple of minutes to give the background story about how our organization got started, because I think it's pretty cool. About 27.5 years ago, Dr. Julie Onimus, who's a local primary care provider who's still in this community, she was diagnosed with breast cancer at the age of 35. She had her initial treatments here, and then her cancer came back. So then she went to Stanford to a breast cancer specialist there. Just happened to be Dr. Ellen Mahoney before Dr. Mahoney moved up here. And Dr. Mahoney had started an organization down in Palo Alto called the Palo Alto Breast Health Project. And Julie went into the Palo Alto Breast Health Project as a physician in 1996. And she was able to get information that she hadn't been able to find as a doctor. She was able to see people who were breast cancer survivors, who kind of gave her hope when she was so sick at that time. And she was just inspired by what the organization did. So she literally came back and talked to people around her kitchen table and said, we could have something like this in Humboldt County. So that's how the organization got started in 1997. And we were initially umbrellaed under the North Coast Clinics Network. And then in 2003, we got our 501c3 and became an official nonprofit. So we've been So that's kind of the founding story about the Breast and GYN Health Project. All of the services that we provide are free of charge to everybody and have been since the beginning. And partly it's, like I said, it's all of your donations, it's some of the grants that we give, and it's all of the volunteer time and effort that people put in. Let's see. And since this talk is really about also tax saving and charitable giving, we do see people who donate through their required minimum distribution. We appreciate that. We have people who are given lots of different ways. Appreciated stock. We have worked with Humboldt Area Foundation a lot, and so that took a little bit of time. So then we started working with Morgan Stanley. It's a little bit, working directly with a broker was a little bit more streamlined, but we work with either Humboldt Area Foundation or Morgan Stanley. One of the things that's kind of cool is we have a volunteer who her former employer lets employees do volunteer time, and if they hit 100 hours, then their former employer or current employer, also if they were working, gives a donation to the charity of their choice who they volunteered with. So that's kind of also a neat gift that if you worked for a large corporation, you might want to see if that's available to you. There's so many ways to give to organizations. We see people donate through their donor advised funds, lots of different ones, including Humboldt Area Foundation. And we do have a fund at Humboldt Area Foundation, so people can donate directly either to the organization or to us directly or to our fund at Humboldt Area Foundation. I kind of nerd out on nonprofit stuff, so it's an honor to be here, and I'm happy to answer any other questions. I really could go on and on because I really love what I do and I love the nonprofit sector. So I'm going to turn it back over to Patrick.
Okay, well, guess I get to play Master of Ceremonies here and turn it over to Mary Keehn from We Are Up, which is a very unique project. And Mary, I do have the video if you want me to play it. Just give me the heads up whenever you want it.
You're mute.
Go. I'll chat a little bit. Thanks, Patrick. And then I have a different video I think we'll work on. But why don't we just do the video first? And then this is one that we created for our fundraiser, which is how we have been surviving in the difficult world of raising funds.
Mary, maybe first just very quickly explain what We Are Up is.
Well, that's why I was going to go to the video, because that's what it does. It talks about We Are Up.
Okay.
So maybe we can do that. Or we don't have the audio.
When you switch
Oh,
it on,
sorry.
Hmm?
Let me fix that.
Because that won't help.
looks like fun.
It is fun.
We Are Up embraces these grand essentials to happiness in this life, that all individuals need something to do, something to love, and something to hope for. The primary goal of We Are Up is to build a community that provides housing for adults with developmental disabilities, seniors, and traveling medical work staff. Our beautiful location in McKinleyville is awesome. There's a bus stop that borders the property, and it is walking distance to grocery stores, a health club, a movie theater, a pharmacy, healthcare services, a bank, and restaurants. In California, 80% of adults with developmental disabilities are being housed and cared for by aging parents and family. Humboldt County is impacted disproportionately in this regard. Local rates are higher than national averages. Adults under 65 with a disability account for 13.2% of our county population versus 8.7% nationally. Seniors comprise 19.2% of our population versus 16.8% nationally. In addition to housing, plans include a state-of-the-art community center for events, classes, and services, including a commercial kitchen to prepare farm-to-table community meals, develop saleable products, and teach life skills. Space rentals that will fill community needs and generate income to keep We Are Up less dependent on taxpayer dollars. And opportunities for residents to access educational and employment services to supplement income in a variety of ways. Since launching in 2021, We Are Up has received a donation of land with clear title appraised at $1.2 million. Secured site control of 3 commercially zoned Central Avenue parcels. Attracted nationally and internationally renowned partners, the Kelsey and Rana Creek. Conducted site studies and received unanimous approval from the Planning Commission. Planted a mature orchard, a vegetable garden, and banked funds for our greenhouse. Raised $1.4 million and benefited from over 7,000 volunteer hours. Been awarded a $1.2 million Rural Energy for America grant. In partnership with Humboldt County, this will enable us to bring improved bus service to McKinleyville. Your continued support is fostering and bolstering careful development of the McKinleyville property, which will be an asset to the community for many years to come. Your support goes to providing much-needed housing, support and programs for adults with developmental disabilities, seniors, and medical work staff, all the while keeping 80% of this beautiful property open space. Thank you.
My name is Fatima Naylor, and I am a board member of this amazing nonprofit, We Are Up. My most important job is being a mother to 2 amazing sons, Caden and Tate. Caden and Tate were both born with a genetic condition called Fragile X syndrome. In addition, my 2 boys have autism and now epilepsy. It is safe to say our cups do runneth, but they do run with pure love, and we want the very best for them, including what their future looks like. And what that future looks like is with the help of We Are Up. When your children turn 18, they become adults, and the next level is an independence of some kind. One day, Chris and I won't be here for our children, and that, again, scares me to death. So, of course, I'm going to be part of a nonprofit that is going to provide accessible local housing in our area. How amazing for Humboldt County that we're going to be able to house adults with disabilities along with seniors. With your help tonight, you will make that a reality. You will help kids like Caden, like Tate, have a place to live when we're simply not here anymore. You in the audience today have a responsibility, and your responsibility is to look around the room and see how many people here today are affected by this. This is in desperate need in our community, and it's going to happen. So right now, today, please get your checkbooks out. Listen to Rex. Bid on items tonight that will make this a true reality in McKinleyville. We need your support more than ever. Thank you.
So that's what we are about. And the real situation is with Humboldt County having a third more higher population of folks with intellectual disabilities living with aging parents. These are the people we are seeing on the streets a lot. And when institutions were closed, nothing was presented as an alternative. So it's the parents who are trying, and grandparents in my case, trying to figure out how to make this work. But we have had a lot of community support, and also in the way of someone donated stock that had appreciated in value. So she got a tax write-off, and we got the current value of that stock. And we've had everything from construction companies offering support to donations of gift baskets and everything. I don't know why the population is so high. I really don't know. we have more seniors, but the difference isn't quite as dramatic either. So I just don't know the answer. People still don't know why autism is on the rise at this dramatic level. But we're kind of late, so I'm going to let Anne go, and then you guys could ask questions of all of us.
Great. So I'm Ann Lindsay. I'm president of the board of Life Plan Humboldt, and Life Plan Humboldt depends on donors to get our community built. We do have a Schwab account, so we can accept stocks directly. So, and what our plan is to create independent living for seniors in a supportive and fun community, and with built-in compassionate assistance as needed, you know, as due to the frailty of getting older, or unfortunately, some of us develop dementia as well. Our goal is to build 144 residences in the McKinleyville Town Center, right just down the street from We Are Up. And we're happy to be, I can see lots of partnership opportunities with We Are Up. And we're going to start in phases with 82 residents to start, and that's so we can use a local contractor. And that's been very exciting to work that out. There's no such nonprofit community within 200 miles. And so board members and volunteers and donors we're working on this Life Plan Humboldt so that we can have a place to age in community right here in Humboldt. And our goal is, the board goal is access to people of diverse income levels. And we have a partnership with Rural Community Housing, which will build low income senior housing for apartments, rental apartments. And then as far as Life Plan Humboldt goes, we are really focused on keeping development costs down so that entry fees to Life Plan Humboldt can be affordable by mid-income seniors and up. And once we're built and operational, we'll be self-sufficient, self-sustaining nonprofit, pretty much, other than donations at that point will probably just help us expand our project programs and work with the surrounding community. Life Plan Humboldt has raised $3 million in donations and grants, and we're probably going to need another $4 million before we get to the point of getting the big construction bonds. In this phase of the development, every dollar donated reduces the amount of money that we need to borrow and pay interest on, and that helps us with our goal of affordability. So you can find out more at lifeplanhumboldt.org. And if you're a donor, please come to someone. We are trying to build a social community while we're building the physical community. So we have parties or social events every couple of months. So it's just so you can get to know your future neighbors. So thank you. And thank you everybody for coming to this, and Patrick for giving the overall how to do it.
Are there any other questions? Respectable or not respectable? We're listening to lots of unrespectable comments lately. Okay, well, I want to thank all of you for participating, and I want to thank our speakers, and I hope you all follow up. I'm impressed the ratio of men to women is actually 2 to 1, 2 women to every 1 man. That's highly unusual. So we can tell who's interested in doing the taxes. I want to basically suggest that you feel free to come back next Monday, which is, no, we're skipping a Monday. We're skipping and coming back on November 18th, pardon me, to talk about euthanasia in thought and practice with Mary Bockover, who is a professor of philosophy at Cal Poly. And it's an option as you age, if you wish to consider avoiding the drama and pain associated with passing. So She's a great speaker. I've heard it before. She's spoken before. And I think you'll really enjoy learning about it and what our policies are in here and what the philosophy of it is. We had an experience with one of our members in our advanced directive group who chose that option to avoid that trauma of passing a very difficult passage. So it's interesting to learn about, and she's a very good speaker. So again, thank you all for coming. I hope you have a wonderful week. We're all still a little anxious with the election, and hopefully we'll start sleeping better afterwards, but it's not clear exactly when we'll know. So if you haven't already, go vote, please. And vote with your pocketbook for these fine organizations, because it's really important that we have them in our community, and they're doing a fabulous job of providing services to us. And we wouldn't have them if not for the leadership of these individuals. So thank you ever so much for being part of OLLI's Brown Bag Lunch program and participating. And obviously, if you haven't become a member yet, we'd love to have you on board so we continue to do this for freebies. You don't have to be a member to attend the Brown Bag Lunches, but you do have to be a member to get an invitation. But you can always go on humboldt.edu/OLLI and get the link and find out what's coming up. We unfortunately have already run out of our catalogs. We need to print more in the future, and hopefully can do that. But hopefully, if you aren't getting your catalog by mail, please call OLLI and ask for it. It's 707-826-5880. We'd be happy to have you join us. Okay, thanks so much. All is well.
Thank you.
Have a good day, everyone.
Bye-bye.